Hi everyone, Aman here from SMC Wolf FX. In this video, I'm going to talk about my London trading session opening strategy. So imagine this, so the London session opens, price spikes, you jump in, and then 5 minutes later, you're questioning every life decision you've ever made. London isn't random, it's not aggressive, and it's definitely not hard to trade. Most traders just show up late and then wonder why they get punished. But what if I told you that London is actually one of the most predictable sessions of the day? I'm not talking about indicators, chasing breakouts, and I'm definitely not talking about sitting there glued to the chart, clicking buttons out of boredom. This is the exact approach I use to trade the London Open by doing, well, less. Waiting for one thing, watching price take liquidity, and then letting the market show its hand before I even think about entering. So if London has ever felt chaotic to you, or if you've ever felt like price knows where your stop loss is, then stick with me, because in this video I'm going to break down my London session opening strategy step by step in plain English, exactly how I trade it and why it works. Let's get into it. If London Open feels like pure chaos to you, sudden spikes, fake breakouts, stop outs that make no sense, it's not because London is unpredictable, it's because most traders don't realize the market already made its decision hours before London even opens. And once you see what price is actually doing before London, you'll never trade this session the same way again. Before I show you anything on the chart, I want to give you a little bit of context. When I first started trading London, I did what most people do. I chased breakouts, I traded indicators, I tried to catch the move the second the session even opened. And some days it worked, but over time the results were inconsistent at best. What I noticed was this: on the days I lost the most during London, price wasn't actually random, it was doing the same thing over and over again. It would spike one way, clean out stops, and then calmly move in the opposite direction. At first, I thought I was just unlucky, but the more I studied my charts, and more importantly, the time of the day, the clearer it became. London wasn't starting moves, it was finishing something that had already been set up earlier in the day. That's when I stopped asking, where is price going, and started asking a better question: where is price likely to take liquidity from first? Once I made that shift, everything else simplified. I stopped looking for multiple setups. I stopped forcing trades every London session. Instead, I built one repeatable framework around how price behaves before London, how it manipulates during the open, and where it wants to go after. This isn't a strategy designed to give you more trades, it's designed to give you fewer high quality ones, the kind where you're waiting for price to come to you, not chasing it across the chart. And that's exactly what I'm going to break down step by step in this video. Alright, now that you have the context, let me zoom out and explain the strategy at a high level without getting technical yet. Think of the market like this: price doesn't move randomly from session to session, each session has a role. Asia, in my view, is where price builds the setup. London is where price tests liquidity, and then New York is either a continuation or expansion, where that usually happens. This strategy is built around one simple idea. When Asia trades sideways, it creates a clear range, and that range leaves liquidity sitting above and below it. And that liquidity just doesn't disappear, it becomes a magnet. When then London opens, price usually moves with the intent in one direction first, not to trend but to grab liquidity resting at one side of the Asian range. That initial move is not the trade, it's the information. Once that liquidity is taken, the market has no reason to keep pushing in that direction. That's when I shift my focus. I'm no longer asking where price is breaking out. I'm asking whether price is showing signs of reversal and redistribution back through the range. So at a high level, my process looks like this. Asia ranges, London sweeps one side, price shows a shift in intent, and I look to trade back towards the opposite side of the Asian range. I'm not predicting which side will be swept. I'm not forcing trades. I'm reacting to what price actually does when liquidity is taken. If you understand this flow, build, raid, reverse, everything else in this strategy will make sense. The lower time frame confirmations, the entries, the targets, They're all just tools to execute this bigger idea with precision. And quick one before we carry on, I have a private Discord where I share live market analysis, daily buys and key price levels using smart money concepts. And if you're serious about improving your trading, I also offer one-to-one mentorship, which is fully tailored to you, no shortcuts, just proper structure and execution. If that sounds like something that you'd benefit from, head over to smcwolffx.com or click the first link in the description. Alright, let's get back into it. So the whole strategy starts with one thing, the Asian range. And if you get this part wrong, everything that comes after is basically guesswork. Here's exactly how I define it. I'll mark Asia from 7 PM to midnight New York time. That's the window I use consistently because I want to capture the part of the day where volatility is typically lower and price is more likely to move in a controlled back and forth way. Now, I'm going to be really clear. I'm not marking Asia because I want to trade Asia. I'm marking it because I want to see if price is building a box, a range, a little pocket of balance. The best Asia ranges for this strategy usually looks like this one here on the screen right now, where price goes sideways, it consolidates, it respects a high and low multiple times, and it doesn't trend cleanly in one direction. Because when Asia is ranging and when it's basically doing is it's creating two obvious edges. The top of the range and the bottom of the range, and obvious edges attract traders. Breakout traders will want to buy above or sell below the low. Range traders will put their stops just outside the range. Either way, the result is the same. You're building resting liquidity above and below that box. That's why I actually prefer a clean sideways Asian range. It's not because it's safe. It's because it's clear, it gives London something to raid. And yeah. Now, a quick filter because not every Asia is valid. If Asia is aggressively trading, like it's already pushing hard in one direction and leaving no clean range behind, I'm less interested because then you don't really have a neat pool of liquidity on both sides. The market has already started expanding. So step one is simple. Every day I'll mark the 7 PM to midnight window at New York time. So the time zone is really important that I'm mentioning New York time. So convert that to whatever time zone that you're in. And I ask one question. Did price build a range that leaves liquidity on both sides? If yes, perfect. That's my foundation. If no, I either adapt or I don't force this model on this day. And once that Asian range box is marked, now London has a target. Now let's talk about the real reason this strategy works. And it's one word that most traders hear but don't actually use. Liquidity. When I say resting liquidity around the Asian range, I'm talking about the fact that the highs and the lows of that range become obvious decision points for the entire market. And anytime something is obvious in trading, it usually becomes a target. Think about what traders naturally do around a clean Asian box. If someone is a breakout trader, they're looking at the top of the range, thinking if price breaks above this, I'm buying. And where's their stop? Usually back inside the range or just under the breakout level. And if someone is a range trader, they're selling the top of the range and buying the bottom. And where are their stops? Just above the high and just below the low. So whether you trade breakouts or ranges, the result is the same. The Asian high and low become zones where, say, orders are stacked up, you have pending orders, stop losses, and emotional decisions. That stack of orders, well, in my opinion, is liquidity. And here's the key idea. Price does not move because it feels like it. It moves because it needs fuel. Big moves need liquidity to happen efficiently. That's why you'll often see price push into one side of the range, grab what's sitting there, and then suddenly the market has the order flow that it needs to move properly. So when Asia has been sideways, I treat it like a map. It basically shows me, here's where liquidity will likely be sitting tomorrow at the London Open. And I want to just be super clear here. This isn't some, say, conspiracy thing where the market is hunting your stop loss. Specifically, it's just market mechanics. If a lot of traders place orders around the same obvious highs and obvious lows, then those areas naturally become high liquidity zones. and high liquidity zones are where price can transact the easiest. That's why once my Asian range is marked, I'm not thinking will London break out, I'm more thinking which side is London likely to raid first, because the raid is what gives me information. The whole strategy is built around this simple sequence where Asia builds the box builds liquidity, and London often comes in and clears one side to create the real move. Alright, so now we've marked the Asian range and we understand why liquidity is sitting above and below it. Step 2 is where most people tend to mess this up, so I'm going to try say this fairly clearly. The sweep is not the entry, the sweep is the signal. During London session, I'm basically waiting for price to something very specific. I want it to take one side of the Asian range. That means price would either push above the Asian high or below the Asian low. And it'll usually do it in a way that looks convincing, like it's about to trend. And this is why traders get trapped, because it looks like the breakout, but I'm not interested in that breakout move. I'm waiting for the raid, the grab, the stop run, whatever you want to call it. And the easiest way to think about a sweep is this: price goes past the Asian high or low just enough to trigger orders, and then it starts to lose momentum or hesitate. So in this example, this is actually from the previous trading day, so just yesterday, the 30th of Jan 2026. You've got an Asian range, it's down, it's up, basically it's not in a trending environment, it's like 25 pips, and as soon as the London trading session had opened, it traded above the Asian range, but the momentum pretty much just it slowed down. But keep in mind, at this point in time, there's no signals that the market is wanting to go lower at the moment. It's just the volume has died down basically after sweeping the Asian highs. So, I mean, sometimes it will be a sharp spike and an instant rejection. Sometimes it's a slow grind above the high that suddenly fails, as you see here on the chart. But either way, what I'm looking for is evidence that price has taken liquidity and is now struggling to continue. Now here's an important filter. I don't call something a sweep just because price touches the level. I want price to actually clear that side, meaning it trades through it, prints beyond it, and takes out what would logically be resting stops. And once that happens, I don't rush. This is where patience now makes you money, because the sweep is basically London saying, cool, we've collected orders from this side, now let's see where we actually want to go. So step 2 is literally me sitting on my hands and waiting for one clean event. London takes one side of Asia, that's it. And once that sweep happens, now I have information. Now I can stop guessing, because the moment liquidity gets taken, the next question becomes, is price about to continue, or has it just finished the manipulation phase? And that's where step number 3 comes in. I wait for confirmation on the lower time frame before I even think about placing an entry. So London has swept one side of the Asian range. That's the manipulation, that's the stop run, that's the raid. Now this next part is where most traders either level up or they keep repeating the same cycle of losses, because after the sweep, you've got two types of people. The first type sees the sweep and instantly tries to fade it, because they're like, cool, that we've now taken out the highs, so I'm going to sell. That's called gambling. The second type, they'll wait for price to prove that the intention has actually changed. And that's what we're trying to do here. So step number 3 is my execution filter. I want lower time frame confirmation on either the 5-minute or the 15-minute chart. And the mindset here is simple. The sweep gives me the location, the lower time frame gives me the timing. After liquidity gets taken, I'm looking for evidence that the market is no longer trying to continue in the direction of the sweep and is instead shifting back the other way. So what does that evidence look like? First, I'm looking for a clear displacement, a strong move away from the swept side, something that looks intentional. Not a slow drift, not a chop. Like the market is saying, we're done up here, let's move. That displacement often leaves something behind, such as a fair value gap and inefficiency. And I normally like that because it gives me a clean area for a retracement entry. Second, I'm looking for a shift in structure on the lower time frame. So maybe we sweep above the Asian high, and then price breaks the most recent low on the 5-minute or the 15-minute. That's a simple way of seeing, okay, the order flow is now flipping. Third, I'm watching for confluences such as order blocks around clean price areas, and this part is important. I pay extra attention when those confirmations form near quarter levels or whole price levels, because those levels act like magnets and reaction points. They're where price tends to respect structure more cleanly. It's not magic, it's just that these are psychologically significant price points where all the orders naturally cluster. So my confirmation checklist after the sweep, it'll look something like this. Did we take one side of Asia? It's either a yes or a no. Did price show displacement away from that side? Again, it's a yes or a no. Did we get a shift in lower time frame structure? Again, either a yes or a no. And then finally, is there a confluence such as fair value gap, order block, or a breaker block forming at a clean level like a quarter or whole price level? And here's the key. I don't need all of them every single time, but I do need price to make sense. I need it to show me that we're no longer in trap traders and continue mode. We're in reverse and deliver mode. Because once I get that confirmation, now I'm not just hoping for a reversal, I'm entering with the market's momentum on my side. So let me quickly show you here on the same example. So from yesterday, so I'm in replay mode. This is the 5-minute chart, and from the previous clip, I've just forwarded it on a few more candles. So we're in the London trading session. It's about 9 a.m. or close to becoming 9 a.m. and this horizontal line, so this dotted line, this is a quarter price level of 1.3825. I've got a separate video talking about how these are pretty important when it comes to trading, so it's on my YouTube channel. And do go watch that when you guys have time. That will help. Anyways, so as you can see, we've gone above the Asian highs, and then price, well, the momentum has now slowed down, and then price began to trade towards the downside. And I'm going to keep this as simple as I can for the purpose of this video. So we've broken this previous low, so we got a break off market structure, and price has now become to retrace back up towards this previous low, so back into like the previous structure and back into this quarter price level of 1.3825. so I can now say that, okay, we've gone above the highs, the liquidity is swept, and now the market has now changed this intention to now potentially trade towards the downside, taking out the Asian lows, so the other side of market liquidity. And from there, the trade becomes very simple, because in step number 4, it will just be like trade back through the range towards the other side of Asia. Now we're at the part everyone cares about, the entry and the target, and I'm going to be honest, this is where people try to overcomplicate things for absolutely no reason. If you've done steps 1 to 3 properly, you've marked out Asia, you've waited for the London sweep, and you've waited for the lower time frame confirmation, the trade becomes almost boring, because we already know the story. Asia created a box, London raided one side of that box, price showed a shift in intent, and now we're looking for the move back through the range. So here's my entry approach in simple terms. After confirmation, I'm not chasing price, I'm waiting for price to retrace into a clean area that makes sense. For example, a fair value gap that was created during the displacement, an order block that was formed near the reversal, or a breaker block that lines up quite nicely with the market structure. And the main thing I'm looking for is confluence at a clean price point, especially quarter levels and whole levels, because those levels tend to act like decision zones. So when a fair value gap or an order block sits right around the quarter level, it just becomes a higher quality area to execute from. Now for the invalidation, the stop loss logic. I'm not placing stops in random places. I'm placing the stop where the setup is proven wrong. So if we swept the Asian high and I'm looking for shorts back through the range, my invalidation is usually above the sweep high or above the structure point that defines that reversal. If I'm using an order block, the stop goes beyond the order block. If I'm using the market structure shift as my confirmation, then the stop goes beyond the swing that would invalidate that shift. The goal is simple. If price comes back and reclaims that swept side and holds it, then my whole idea is wrong and I want out. Now for the target. This is where the strategy becomes super clean. My primary profit target is very simply the opposite side of the Asian range. That's it. Because remember what we said earlier. The Asian range has liquidity sitting on both sides. London usually tends to raid one side first, but the other side is still untouched. So the delivery move often wants to travel towards the opposite side and clear that liquidity too. And this is why I love this strategy. It gives me a target that's not emotional. I'm not trying to snipe the exact top or bottom of the day. I'm trading from one liquidity pool to the next. And when you combine that with higher time frame bias, it becomes even more powerful, because now you're not just trading an intraday move, you're trading in alignment with the bigger narrative. Now, before you start thinking that this strategy is just sweep one side and trade to the other side every single day, we need to talk about the one filter that keeps this model clean: higher time frame bias. Because yes, the market loves to sweep liquidity, but it doesn't always reverse the way you want. Sometimes it sweeps one side and then keeps on going. So higher time frame bias is how I avoid trying to fade a move that's actually meant to continue. Here's how I look at it in simple, practical way. Before London, I do a quick top-down check. I'm usually looking at the 4 hour and the 1 hour, and also the daily if we're at a major level. And I'm asking a few basic questions. Are we trending bullish or bearish on the higher time frame? Are we at a premium or discount relative to a clear range? Are we sitting at a major higher time frame level, like a daily high or a daily low, a previous week level, or a clean order block area? And most importantly, does it make sense for price to seek liquidity in a certain direction today? Because higher time frame bias isn't about predicting the future. It's about aligning your intraday setup with the bigger narrative. Let me give you the simplest rule that keeps this clean. If my higher time frame bias is bullish, then I'm mainly interested in one version of this strategy. I want London to sweep the Asian low, and then I want confirmation for longs back towards the Asian highs and beyond, because that sweep is basically price grabbing sell side liquidity before continuing with the bullish narrative. And if my higher time frame bias is bearish, then I flip it. I want London to sweep the Asian high, and then I want confirmation for shorts back towards the Asian low and beyond. So the bias tells me which side of the range I actually want to see taken and which setups I'm willing to ignore. This one filter alone stops you from taking pretty reversals that are actually counter trend traps. And here's something that will save people a lot of money. Some days the best trade is no trade. If the higher time frame is messy, like we're middle of the range with no clear direction, or we're in a heavy chop, or price is sitting in a weird spot with no clean liquidity narrative, I'm not forcing this model just because London is open. I'd rather miss a move than take a trade that doesn't make sense on the higher time frame. So the way to think about higher time frame bias is the Asian range gives you the map, London gives you the raid, lower time frame gives you the entry, higher time frame gives you the direction and the permission to take the setup. And once I've got that aligned, the strategy becomes way more consistent because now I'm not trading an intraday swing, I'm trading with the market's bigger intention. Now, before we move on, there's one filter that's just as important as structure, liquidity, and bias, and that's news and risk control, because even the cleanest setup in the world can get completely destroyed by unexpected volatility. So part of my London routine every single day is checking the economic calendar before I even think about trading. I'm not looking to memorize every data release. I'm just scanning for high impact red folder news that could inject sudden volatility into the market. Things like interest rate decisions, inflation data, employment number, basically events that can cause price to spike aggressively without respecting structure. And here's my mindset around news. I don't try to trade because of news, and I don't try to be a hero holding through news either. If there's high impact news scheduled right around London Open, especially within the first hour, I'm usually taking a more cautious approach, because when news hits, price isn't reacting to liquidity in the same way. It's reacting to information, and that can temporarily override structure, levels, and even higher time frame bias. Now, this doesn't mean that the strategy stops working on news days. What it means is that timing and risk needs to be adjusted. Sometimes I'll wait for news to pass and let the volatility settle down before looking for the London sweep and confirmation. Other times, if the timing does not line up cleanly, I'll just accept that it's a no trade day, and this ties directly into risk control. I'm never increasing risk because I feel confident. I'm never trying to revenge trade because I missed a move, and I'm never forcing a setup just because I'm sitting at my desk. My risk per trade stays consistent. My invalidation stays logical, and if conditions are not right, I simply don't trade. That's a big mindset shift for a lot of traders, but it's important. Not trading is a position. Protecting your capital on uncertain days is just as important as making money on clean ones, because this strategy isn't about winning every London session. It's about staying disciplined enough to only trade the ones that actually make sense. Now, before you go and try this out tomorrow, I want to cover the most common mistakes traders make with this strategy, because the model itself is simple, but people still find creative ways to ruin it. So, mistake number 1, trading the sweep like it's the entry. This is the biggest one. Price sweeps the Asian high or low, and instantly traders jump in thinking this is the reversal, but a sweep is not confirmation, it's just the market grabbing liquidity. If you enter right on the sweep with no market structure, no displacement, no confirmation, you're basically flipping a coin and calling it a strategy. What you should be doing instead is treating the sweep like a headline, not the full story. It gets your attention, but you still need the details. Mistake number 2, forcing the setup when Asia didn't actually range. Some days Asia is clean and sideways, perfect. Other days, Asia trends hard and doesn't build a proper box. And if you try draw a range anyway, you'll convince yourself there's liquidity sitting on both sides when there isn't. That's how people get chopped up, because they're trading a model that doesn't match the day. Mistake number 3, ignoring higher time frame bias. This one will hurt you slowly. You'll get a couple of nice wins and think, I can just trade this every day both ways. Then you'll fade a sweep on a day where the higher time frame is trending aggressively and price will keep going, and you'll sit there thinking, why did it not reverse? Bias is the filter that tells you whether you're trading with the market or trying to be the hero. Mistake number 4, overloading yourself with confirmations. This is sneaky because it sounds smart. People will be like, I need an order block plus a FVG plus a breaker, plus a triple confluence, plus a 9-frame alignment, and by the time they've finished confirming everything, the move is already gone. The whole point of confirmation is to get clarity, not paralysis. You need the sweep, then you need a clear shift in intention on either the 5-minute or the 15-minute, and you need a clean area to execute from. Simple, clean, and repeatable. Mistake number 5. Taking every single day as if it's a setup day. Some days London is beautiful, other days it's just chop or prices mid-range, or the market is waiting for news. This strategy isn't meant to give you trades every single day. It's meant to give you a framework for the days where London behaves like London. And the last mistake, this one is more mindset than technical. People turn this into a revenge strategy. They miss the entry, they get faked out once, they take a small loss, and instead of stepping back, they keep trying to make it work. They start forcing entries, widening stops, taking low quality confirmations, and now it's not the strategy failing, it's discipline failing. So if you take anything away from this section, it's this. The strategy is simple, but the edge comes from patience. Wait for the sweep, wait for confirmation, execute from a clean area, target the opposite side of Asia, and if the day is not giving you that, then don't try to force it. That's how you keep this model consistent. Alright, so if you zoom out, this whole London strategy really comes down to one idea. London doesn't reward speed, it rewards patience. Most traders lose in London because they treat it like a race. They want to be first in, first to catch the breakout, first to catch the move. But the market is not paying you for being early, it's paying you for being right. And the way you get right more often is by letting price show you its hand first, where Asia builds the range, London raids one side to grab liquidity, you wait for confirmation, a real shift in intent on the lower time frame, and then you trade back towards the opposite side of the Asian range with structure and logic on your side. No guessing, no chasing, no revenge trading, just a repeatable process. And here's the mindset piece I want you to take away, because this is what separates amateurs from professionals. You don't get paid for activity, you get paid for alignment. Alignment with the higher time frame, alignment with liquidity, alignment with timing. So the next time London opens and you feel that urge to jump in, pause, ask yourself, has liquidity been taken? Has structure shifted? Do I have confirmation? And does this move make sense with the higher time frame? And if the answer is not clear, you don't force it, because the real flex in trading is not catching every move. It's having the discipline to only take the ones that make sense. Now, if this video helped you see London a little differently, and if you got value from this video, do me a favor, hit the like button, subscribe, and share it with someone who's been getting chopped up at London Open. I'll see you guys in the next one.